Because I feel
Yeah,
like
that's
real.
Now we're serious. See.
Now,
All right, now it's
now
legit.
be yourself. Good morning, everyone. So they're all loading in right now. We're waiting patiently for them to get there.
Is the other thing we haven't overwhelmed it. We haven't figured out how to just start the show when we see everyone. We only have 20 people in currently, and we're waiting for the other 150 to roll in. And so it's always a challenge with this system, but it's so far the best system we've found to work. We've tried them all.
Well, we didn't
And
try
some are
teams.
fast.
I don't think we tried teams, but you know.
Yeah.
Anyway, good morning, everyone. Thank you for joining us. Thank you for being here. We're very excited to have you. And we're really happy to welcome Erin Dee, who is the COO of LoanPeople. She's a new addition to our guest lineup, and we're really happy to have you. So good morning, Erin.
Hello, how are you?
Great. Good morning, Kevin Casey. How are you?
Good morning. Although it's not morning for Erin.
Nope, just past lunchtime.
Yeah.
Oh my gosh. Okay. Do you see, we already have a comment. Oh my God. Is that
Hi,
Erin
Matt.
Dee won NBA Future Leaders? Wow. In the presence of a superstar? Wow. Wow.
It was a team effort, Matt, not just me.
Oh my God. I love people like her. I love it when they're like, wait, it wasn't just me. We all did it together. Like that is not everybody's messaging. Let me tell you.
Matt
Yeah.
does have the line on the best breakfast burrito in San Diego, though, I will tell you that.
Oh, he's in San Diego. And well, San Diego is known for its, anything having to do with Mexican food. It's the best down there, right? So anyway, with that, let's get this thing going, shall we?
Sounds great.
As always, there's a lot going on in the market, and today is a roller coaster, isn't it? Holy guacamole. We start off down, then all of a sudden things get better, and now we have more to lock again. I'm like, we are always telling people we have much more to lose than to gain in this market. So don't dilly-dally when it comes to locking your loans and making sure you're protected. So what are you seeing on your end with all that, Erin?
I mean, same thing. I actually literally just had a conversation with one of my loan officers about that, and he decided to wait. And when he did that, he lost, a lot of basis points in doing that. I think right now the smart money is to not try and play the market. It's just a fool's errand. I think you just got to get in, lock it. And if rates improve throughout the process, chances are your company has a renegotiation policy you could take advantage of. I think that's it. Just safe, just lock it in at what the client knows what it is and move on.
We've had a little ditty that we've been singing since everything was, blue skies and sunshine. If you see a rate you like, lock it in.
Yes.
Oh my, yes, right. It's funny. We're all so, and I am guilty of it, just like everyone else, where you're just so fixated on that. And I've tried to ease myself away from that, because if you're riding the wave of the volatility in this market, you are going to need medication. It is hard.
Yes.
It's so
hard
painful.
alcohol.
And you have to set the proper expectations with your borrowers, right? Because if they are counting on you and you are all over the place and freaking out, it's not good. So you need to, we've talked about this a lot. You need to make sure that you're talking about payments, especially when they're not even in contract yet, right? Because if you're talking about rates and you quote them something and then it's gone, they're going to think that the whole world just ended, and they're going to be so sad and upset. And whose fault will it be? Probably yours.
It's always your fault.
Yeah.
Well, it's always my fault.
Kevin.
Definitely.
Yeah. Oh, don't do that
I've
whole
learned it's
man
not always
murder
my-
thing.
I've learned it's not always my fault, but I always have to take responsibility for anything that happens during the loan process.
Look at that.
Okay. I'm glad I
Ownership.
clarified that it was during the loan process, because the other part, anything else, complete baloney.
He's out.
Exactly. Okay, so there was, these hours go by so fast that a lot of times I'll have a list of things to talk about. We won't even get to it. So there was a memo last week that was being circulated from Wells Fargo, and it made everyone think that they were bailing out of the market, right? And so, so tell us what you're hearing on your end.
Yeah, absolutely. So I had a phone call last week, and I was assured that they are not exiting correspondent. They're still there. What they are doing, which makes a whole lot of sense, is looking at those customers who maybe focused too much on refis and have now lost money throughout the year. Those are probably not going to be long-term clients for them, which again makes sense. That's basic counterparty risk, especially being a financial banking institution. That's just their basic governance they have to do. But they are still here. They're still originating loans, purchasing loans, at least as of right now. So that's the clarification I received.
That is great news. And that really is what we were hearing too, which is, and again, we always qualify this with, this could change at any moment. This is not.
You need like an asterisk tattoo.
This is not the head of Wells Fargo, assuring me in writing with, her thumbprint on in her blood, saying what's going to happen. That did not happen. Okay. This is what we are hearing, right? Okay. That they're scaling back, but they're not completely exiting the channel. And so we'll keep you posted if we hear more information on that. And if you are sitting in your office going, Wells Fargo, I can't send loans to Wells Fargo. They have a correspondent channel that some of us use, and that's what we're talking about. So anyway, what?
Especially for jumbo.
But boy, they're tough.
Yes.
They're
tough. But you know what? We've been through this before with Wells Fargo. Historically, they do this regularly, where they reevaluate their market. And it's something for them to be doing. It's like, hey, which mortgage companies are we making profit with, and which ones are we not making profit with? Let's shut off the ones we're losing money for. Focus on the ones that are making us money, and that's why they're so big.
Yep. Yeah, absolutely. And again, it's basic governance, and you have to think about it from a risk standpoint, right? So I think it's no secret that we're seeing that the agencies are getting caught back up on their reviews of loans. We're seeing the amount of repurchase demands increasing. So if they're dealing with counterparties who aren't making money, who are losing money, and who perhaps couldn't fulfill those buyback purchases, that puts all the risk on Wells Fargo. So it makes sense if you think about it.
Yeah.
Okay, so what I really love about you, Erin, and again, we are just getting to know each other, is that you have such an interesting background. So you are 20 years in the business, and your first job out of college was being an underwriting trainee for a subprime company, right?
Yes.
Where you worked for 5 years, and then you moved on to something else. So you've been in all facets of the mortgage industry, right? And you have some insight into some capital markets, right?
Yeah, absolutely. I've spent some time there. I oversee it here at my company.
Okay, so we know that this market is volatile. It's crazy. Like 1 minute, things look great, and the other minute, today's a perfect example of that, isn't it? So we felt like rates had sort of peaked in the middle of June, and here we are towards the end of August, actually, and we still have some rough waters ahead with the inflation numbers that are coming out September, October. It's probably not going to be, everything that we were dreaming of. Do you have any insight into approaches that people could take to how they manage this uncertainty and volatility?
Yeah, absolutely. And I think those two words are key. You have a ton of uncertainty. You've got, hey, for a while there, it was looking like US inflation numbers were beginning to subside. Then all of a sudden, European inflation numbers come in crazy. Then our PMI comes in, and then this. So, that uncertainty and where the numbers are going and where the trend is, because there's really no trend yet, is leading to a ton of volatility, which then is leading to conservatism on rate sheets. So, I think if you just go back to what we discussed today, which is lock your borrowers in when they're ready to go and don't try to play the market, that's really just going to be your best bet, because it's going to continue to be a roller coaster ride. I don't know what's going to happen tomorrow. Who knows, right? So all you can do is just play the market, play the game that you have today. And again, take advantage of your company renegotiation policies, your investor renegotiation policies. Take a minute to understand those. Look for opportunities for float downs if the market improves, right? So, some are more friendly than others. Maybe some don't have them. But for you as an originator, one important tool that you have is understanding your opportunities for float downs, for renegotiation, so that you can then jump on those when that market has a good day, because you never know, that next day might be bad again. So you want to be able to jump on those quickly.
Yes. And those conversations are easier once they're in contract and you have a time limit, so they can't think around with that too much. But for the when I'm talking to borrowers about locking, and they're like, well, can I have a lower rate? And I explain to them, we are both making commitments here. You're committing that this is a rate you're going to be comfortable with, and they're committing that no matter what the market does and how horrible it gets, they're still going to honor that rate. So you're making an agreement. You both have to fully your part of it. Don't forget that. So again, our messaging to our clients has to be clear, and you can't just, and I know there are a lot of people out there who are, all they care about is rate. there's so much more that goes into it than that. And so again, we need to be talking about that as much as we can, right?
Yeah. Yep,
Yeah.
absolutely. And in the end, and you know, there's always going to be the times when you get shopped and you're halfway through the process, you just got the appraisal in and they're like, oh, look, credit union down the street gave me this better rate. And so again, that's where understanding, hey, if market truly has improved, can you move quickly to try to get a better deal for them and keep it? So, you know,
Right.
again, just understanding all your company's policies will allow you to be far better when you have those competitive situations.
Right. You're like, good luck with that.
Yeah.
You have to close in 10 days. Yourself out. One of the things that we were going to talk about was the different, you know, IMBs versus banks,
Yeah.
and how that all impacts pricing and how the market is looking for us these days. So why don't you speak to that?
Yeah, absolutely. You know, I think when you're just talking straight agency business, IMBs and banks are on a pretty even scale from a competition standpoint. You know, banks obviously, just depending on their comp structure, can tend to, they have lower comps. So, you know, there you may be more competitive there. You just have to understand your value proposition, understand who you're competing against and where you're better if you're an IMB.
And
But
hang on,
yeah.
just to refresh everyone's memory, IMB is independent mortgage bank. So that is anyone who is not like Wells Fargo, Chase, you know, those guys.
Non-banks.
It's non-banks, somebody who doesn't take deposits. So all your wholesalers, those are typically IMBs. And if you're
Yes.
working for, you know, a retail operation, that's probably an IMB, right, Erin?
Correct. Yeah. And I have actually recently heard the expression used independent mortgage brokers as well. So I'm
Oh,
seeing a
interesting.
dual use of the IMB model.
Really? Is that a thing though? I mean, that's not.
I've seen it. I don't know if they're trying to just get it to become a thing, you know, like giving yourself a nickname. I don't know, but I tried doing
Hey,
that.
Sasha. Wait, what?
I tried to give my nickname, myself a nickname of Seabass before after watching Dumb and Dumber. It didn't stick.
Probably best. I would have a very hard time right now with this conversation if I was saying, the Seabass, tell us about that.
I don't know. I think it'd be funny. Once or twice.
I know, right? We would just go with that. Kevin, every time you hear the word sea bass, I want you to like jump up, do a dance, spin around and sit down again. Okay. Anyway, back to the IMBs versus banks, or not versus, but you know.
Yeah. So, you know, straight agency deals, you know, you're not going to have too much competition there. But right now, where we're really seeing banks have an advantage is when you're talking about ARMs and when you're talking about portfolio deals, right? They've got the portfolio, they're retaining, they're keeping that, and they're really, really strong there. And, you know, end of 2020 into 2021, when banks were absolutely flush with cash, it was actually fairly, and I say fairly easy, but there was a lot of relationships to be had, ourselves included, where we had relationships with local community banks, local credit unions, where we had these portfolio products where we could sell them to banks super competitive because they just had so much cash they had to get rid of it. That's changed. You know, I think they've kind of filled portfolios up, and also now with rates going up, they have some better investment opportunities with shorter durations. So, you know, so we don't really have as many opportunities for partnerships as we did. So right now, that's really where we're seeing IMBs at a disadvantage against the depositories.
I think that this is pretty normal though. We as LOs, we have often dealt with the fact that, you know, a big bank is going to wipe us out when it comes to jumbo pricing. Typically, we're seeing it with ARMs, with credit unions too. It was funny. We, our company had a relationship with a credit union during, you know, when things were great before the pandemic, and you could get smoking hot jumbo pricing with them. And then all of a sudden, instead of getting smoking hot pricing, you were paying literally $30,000, $40,000, you know, in points to get any sort of rate with them. I'm like, oh, maybe they don't want to do loans anymore with us. Okay, moving right along. So
Right, yeah.
the market is constantly shifting, but this whole jumbo conversation is not new. And also our understanding is that the ARM pricing has been impacted by the fact that lenders or investors are looking at it going, well, wait a minute, you know, we're expecting, if not a recession, at least something that will create better rates down the road. And we don't want to get stuck with a bunch of, you know, EPOs and
Yep.
yeah. So why don't you speak to that a little bit, just to remind everyone what they're dealing with?
Yeah, absolutely. I mean, it's, you know, I actually have spoken to several people from banks right now that, going back to that uncertainty and volatility word, where ARMs are still, they just don't really know how to price them yet. They're not super comfortable with them because, again, we don't know where this is going. And so there are several people who are predicting a mini refi boom, you know, maybe towards the end of the year, beginning of next year. I've heard that. So I think that they're still, again, going back to that, they're not really keen on purchasing these for a big premium because they don't know how long they're going to be on their books. I know we've seen an uptick in EPOs in the last 5 or 6 weeks, I would say. And speaking to one of my investors yesterday, he told me they have more EPOs than he's ever seen in the history of his being there. Yes. So, and I think some of that is in July, we did have rates improve a little bit. So I think there was some advantage taking there. What we've seen, we're in the Austin market and we've kind of, we're kind of tipping out where values we're going up really high. And I think we're seeing some flipping as well. People trying to take advantage now that the market is moving. So yeah, EPOs are a big deal. A lot of talk about a potential refi boom. So that also is creating that uncertainty within investors not wanting to pay big premiums for ARM loans.
Wow, I had not heard that about EPOs recently. Do you, Kevin?
Mhm.
Well, I had one personally. I had a client who wanted to refinance the loan I just did with them. We talked about that one.
Yeah.
I talked her out of it. Oh no, you don't want to do this.
Good job.
She also had a prepay, so it was like,
Ooh,
you don't want this. It was on her investment.
DSCR. Yeah.
And she didn't listen to my advice back at the time that you really want to take this time. We closed her back in February or March. I can't remember now. It's like, rates are great. They're getting worse. You have an opportunity now to take some cash out that's really cheap compared to what the rates have gone to. We can flip this to a cash out loan and get an extra $100,000. And she's, oh no, I want to keep the balance really low and just pay this thing off. I'm like, okay, but you understand rates are going up and you've already locked in this great low rate. You might want to take advantage of it. No. And now she comes to me like, I think you were right. I should have taken the cash out, but can I take out the cash now? I'm like, well, your rate's gonna go from, I forget what we had her at, 3% or something. Now it's gonna be 6% for this investment property and it's a DSCR, and I'm like, it actually got the 7. And it's
Now
like,
it's 10.
yeah. So it got crazy. But
Yeah,
anyway, talk her out of it.
if anyone has a good way to say I told you so to a client, could you please share that with us? Because
Per my prior email.
referring back to what I had said multiple times, I'm the mortgage professional. Maybe you should pay attention. I don't know. I'm just saying.
Yeah. What do you do?
Okay. So data. Let's talk about data for a minute. I mean, it's kind of a general, boring word to a lot of us, but it's really important in this market, isn't it? So tell us about that, Erin.
Yeah, I mean, data from all over, right? So one, understanding your portfolio, understanding your pipeline. So where your interest rates at, your borrowers, but also just understanding your business. So, as a company and also as a loan officer, understanding your profitability, where are your cost drivers? If you're a P&L LO and you're looking at this, don't just look at the bottom line. You need to look at what goes into everything. Where can you make improvements? Where can you become more profitable where you need to be? And also, if you're pretty profitable, where then can you try to drive in more business and use that money to reinvest in your business, right? If you are not a loan officer who sees your profitability, you need to ask for it, right? Because I can be sure that your management is looking at your profitability and understanding what team do you have, what are you spending on verifications, all of that kind of thing. So make sure just you as your business, where you're all mini entrepreneurs, right? You need to understand the profitability of your business in a time like this, because you have to be able to get ahead of that before your company does, before your management does, and allows you to make the changes you feel you need to make in your business before they're made for you.
Well, we are seeing that as companies all over the place are, laying off entire swaths of people, and it's not just operations, it's LOs too. And so it is important that we are looking at, okay, are we worth it? Like literally.
Yeah.
And if you haven't asked that question, if you're not thinking about it, if you think, oh, well, someone else is paying for that, ultimately that trickles down to us, and we need to be aware of it, right?
Yeah, and understanding your marketing spend, right? So really taking the time to understand where your leads are coming from, what marketing campaign, is it past customer? Is it some other marketing campaign that you've done? Is it from a drip campaign? Is it from a realtor, right? So if you have a marketing spend, you can understand what's the ROI on that marketing spend as well. So you're not just throwing money out there that's not helping you, and instead you're taking that money and putting it in the things that truly are helping you.
Well, that leads us right into how do you survive in this market? Because a lot of people don't have systems. They don't have leads coming in. Although in the past week and a half, I'm getting reports that phones are ringing more. I'm seeing it more in my business. There is, it seems like maybe there's more activity out there. And, but what should people be doing in this environment to survive and get through it and thrive and be prepared for what's coming next?
Yeah, so, I actually have a theory on that. I think after 2 years of COVID and lockdowns, it seems to me like people in general took this summer off. They finally took vacations. I saw people take vacations that they didn't take. And, I think obviously the market being a little cray fed into that. But I also think this summer people just took time off and just enjoyed their families, got away, kind of took the vacations they've been wanting to take. So because we're also seeing the same thing, and school is just now going back. So I that's kind of my working theory. I don't know if I'm right or not.
That's a good theory.
Yeah, yeah. So
has no kids in school and hasn't worked since May. So I don't know what his deal is, but but the school thing, you're totally right. Actually, now that I'm thinking about it, because it does coincide with that. Kids are going back to school. Oh, hello, ding, ding, ding. Thank
yeah.
you for pointing out the obvious.
Yeah, I'm a childless heathen. The only reason I know is because my Facebook now has all the kids with the little prison looking signs about their first day of whatever grade. I don't know. So that's where that theory comes from.
Yeah. One of my college students went back on Saturday. The next one goes back like, September. So we're getting there, right?
Yeah, absolutely. So to get back to your original question, right? So how do you survive? I think for me, the key is discipline. Discipline is super easy when times are good, right? Like my favorite example. So when you are going to get your teeth kicked in all day because of leads or loans going through or whatever reason, meetings, you are going to get up at 5 a.m. and you are going to go for that run because you have no other opportunity in that day to go for that run. If you have a light day, things aren't going on, your phone's not ringing, you're like, maybe I'll sleep in. I had a few cocktails last night. Maybe I'll go for a run at lunch or something or after work. But then the day kicks in and maybe you get a lead and you don't go for a run at lunch because you call that lead, or maybe you go for a run at lunch and you miss that lead, right? So there's so many opportunities for your day to get messed up if you don't stick to the schedule. So to me, success in this time is in discipline more so than when things are slow. So, don't get sloppy. I have seen it, and my investors have even told me this, that they're seeing files from their customers coming in far sloppier than they did in 2020, 2021, because it's just, people tend, when you slow down, you get a little loosey-goosey, right? You need to take the empty time that you do have with what got you there in the beginning, right? So are you doing copies, back to the basics, calling realtors, dropping off swag, meeting people? Speed to lead is the biggest thing, especially right now with so many loan officers chomping at the bit for business. If you miss a call or you don't call somebody back on a weekend, you want to wait until Monday, that lead is gone. Somebody else jumped on it, somebody else who was willing to work a night, somebody else who was willing to work a weekend. So it's really just getting back to the basics and staying disciplined. Fill your calendar up, calendar block, put activities on there that'll helpful for run your business and stick to it. And then if you can't think of anything else to do, find a need and fill it. Find a training need. Is there a program you want to learn? You talk about DSCR. I know that's a new program. We've done a ton of them, but if you haven't done them, it can be kind of tricky. Can I close in an LLC? If so, what do I need to close in that LLC? Right. So all those kinds of things. Our investors, Matt just made a good point, learn new products. Our investors put out so many good trainings about different products that you can do. So learn new things. So really that's it. It's just staying disciplined. Don't let that empty calendar space make you sit around twiddling your thumbs. Give yourself tasks to do and do them and stick to it. And that to me is what the loan officers that I see today being the most successful are the ones who have done that. And they are doing great. Their pipelines are nice and full right now.
I'm seeing the same thing. And just for the record, discipline has always been a dirty word for a lot of LOs, and we need to get over it. We really do. And I mean, I'm seeing people who are at home and they're like, it's so easy to get distracted by what's going on at your house. Maybe it's time you just go back to your office. Maybe it's time. If you're not able to focus and get yourself on track from your home, think about that and make an adjustment. So it is, and again, for me, I used to be, oh my God, I was so loosey-goosey, holy guacamole. So 33 years in the business. And for the big first part of it, I was like, I'm supposed to have a loan, I will, like it was just ridiculous. And I think back and I'm like, I was so young and stupid. It was ridiculous. I'll say ridiculous one more time for emphasis, because that's what it was. But and I was like, I can't time block. How can I time block? Because I'm an LO and who knows what's going to happen. There will be some fire to put out. Well, if all we're doing is reacting all the time and you're not being proactive about making a plan for yourself, nothing will ever be achieved. You're just going to be putting out fires all day long. And that is not the way forward in my experience. I wouldn't even say opinion. I will just say forward. So Victor is saying, I have a question. So Victor, ask it, and we'd be happy to entertain that in here. There's a lot of chats in here and there are comments, and they're saying their kids are starting school. The school's starting early. Jill is saying, get your CMA, which is your certified mortgage advisor. She was part of the group that we had put together where we're working to get that done through MBS Highway. She was the first one to cross the finish line. So she is now certified, which is great. I'm about to start another certification through NAM. So, I mean, it is, okay, how do you differentiate yourself from other loan officers, right? And you're talking about the leads and being responsive. At my understanding with people who are buying leads, like trigger leads, they are down to the second, no kidding. I was talking to a guy who creates software for the industry, and when they're filtering in those leads, I mean, it is how many seconds can they knock off of that? And they have to respond immediately. I mean, that's not my business. It never has been, but for people who are doing it, holy smokes, that's a lot of pressure, right? You have 2 seconds to respond, or 15 other people will. Wow.
Yeah. So, and I apologize because I don't have the website. I can send it afterwards. So what we've seen an increase of is, as soon as we pull credit, all of a sudden they're getting calls from other lenders, exactly what you're talking about, right? And we're like, well, but we don't pass phone numbers through. How does that happen? Well, apparently there is a more expensive type of lead that nobody used to buy until recently, where they can use other data sources and match that borrower to a phone number, even if you're not passing it.
Yes.
And that's how they're getting that contact information. But there is a database, there's a national registry that you can have your borrowers go and sign up to where it's basically do not call list for those trigger leads. And so I would suggest implementing that.
We talked about that last week. We had Tracy King with Partners Credit on, and she was great. And
she's awesome.
So she was saying that they opt out. We were asking, how long does it take? And it's a couple of days, but it's something you can do for your borrowers. And for any of us who have gotten a mortgage recently, oh my God, you're inundated. And I had said that NAM, National Association of Mortgage Brokers, has dropped a trigger lead bill in Congress last spring. It's not going to pass this year. There's no way, but they keep trying. And it's not to block, it's not to make it so that you can't have trigger leads, because we know that leads are part of people's businesses. However, it's so people have to opt in to wanting them versus having to opt out to not have them. And so that is, that's a whole different thing. So I know that they're going to take another run at it next year, but in the meantime, we have to deal with it.
Did you read Tracy's comment?
Thank you to Tracy for posting the and Kevin.
Yeah, I beat Tracy to the punch, but she did the better way of doing it.
Not nicely done. You're not just eye candy, Kevin. You're so valuable to the whole operation. It's good. Okay, so we have a comment here from one of our loyal listeners, Harry, who is old enough to not have to do the continuing ed to renew his DRE license anymore. He said, my main job is who has the best happy hour with a senior discount. And he says, I'm still a rookie after 33 years. I'm like, yeah, next to him. But what's funny is even less than a year ago, it was feeling like, okay, we're all so old. We are all so seasoned. All these young people, they're so much better. And now those poor kids they haven't been, or anyone who hasn't been through these cycles, this is brutal.
They're not okay.
Yeah, it is not okay. So help them understand that, it's just like when you're raising kids, you don't like a stage, don't worry, it'll be over soon. Right. So this is going to pass. You just have to survive it and get through it. Right.
But you'll be better for it because you will create systems. This is when you create your systems.
Right.
And, if you create a system, one of the best systems I ever created, I need to go back to creating this again in this current market. But I had it where I made 10 phone calls a day. That was it, just 10 phone calls a day. Mondays was realtors, 10 realtors. Because why? Because they just came off open houses and such. And so they had some clients they're working with. And so it was a good time to say, hey, anything I can help you with. Then on Tuesdays, I was calling all my current clients, just giving me a quick update. Hey, do you know anybody else who needs a referral? And it was just, but clients love that Tuesday update. And then Wednesdays was business people, call the business people. So, financial advisors, attorneys, CPAs, anybody else that, not a realtor, but they can get you business, call them. And then set up lunches and stuff. That was the other trick to that one. But anyhow, then Thursdays, I was back to calling past clients. Friday, calling realtors again, because they're going into open houses and they need some help. They might need a flyer, they might need something. And you just keep doing that 10 calls a day. It's all you need to do. And honest, I didn't always get
Kevin. Are you still doing it, Kevin? Are you spending your days?
I have been lazy because I've been getting the 10 phone calls, and now I need to go off where I'm making those 10 phone calls.
He's full of crap. He just sits at home and gets distracted by the dog. I mean, come on. Oh my gosh. Okay. So one of the things that we have talked about over the weeks is being careful about who you're sending your loans through, and do not just chase the lowest rate because it sounds good, right? And so we have said, make sure you're vetting the lenders and investors that you're working with to make sure that they're still there on the, at the end. So you had some good ideas, Erin, about how to vet somebody and what to look for. Can you share that with us, please?
Yeah, absolutely. So, what I try to look for, and granted, this is not always a successful venture, but I've had good success with it, is really one, looking at, what is the totality of their portfolio? Are they only non-QM, a non-bank who's only like a non-QM? That's a lot riskier. That market has come in and out a lot, especially recently again. Not to say those aren't great guys or great players, but if their whole focus is on non-QM, that's a far riskier play for you than if you're dealing with a much larger investor where non-QM is a smaller part of their portfolio. So I like to stick with investors who have non-QM. Like if I'm looking at a non-QM, I like to look at ones that have non-QM just as a small part of their portfolio, and have a much larger portfolio of just straight agency type deals, prime jumbo, that kind of thing. I feel much safer about my ability to get that loan, not only get that loan funded, but purchased. And then the other thing that I look at is, who are they backed by? Again, are they just a small kind of non-bank, non-QM type deal, or are they a financial institution? So if this is a larger bank, a regulated bank that is offering this product, you have a far greater chance of being able to get to the finish line being loan purchased, than you do with a smaller company that maybe doesn't have the backing, doesn't have the financial, or doesn't have the regulation behind them that keeps them safe. And so, perhaps, as I think a good example recently, there was a great investor who was a bank who had a really good jumbo or a really good doctor program. They discontinued that product, but they were able to honor the locks that they had open. If it was just a regular non-bank type lender with that type of program, they may not have been able to honor those locks or had the ability to do that. So that's kind of what I like to look at, is what's their overall portfolio, and do they have the backing to be able to sustain this product?
So you said something really important in there, which was the finish line is not when we fund and close the loan. The finish line is once that lender has sold it. That's really the number one interest of any investor, is, can you sell the loan, right? So it's just, you're not done till that thing is sold to the secondary market. So that knowing that those companies are solid and can do that is really important. And I think it's interesting. I haven't heard this take before, as far as choosing lenders who have a mixed portfolio of products.
Yeah, that was a good one.
I have, a lot of time the messaging is, this is all we do. We're experts at it. We have our own, secondary market outlets. And so we're the best option. So interesting perspective that I hadn't considered before.
In 2020, it was a lot of the companies that were just the non-QM specialists that disappeared on us completely.
That's right.
And it's happening again.
It is happening again. That's interesting. So just be on the lookout and have conversations, ask questions, ask your reps. But then you have some place like First Guarantee who went out and they had the best backers. They had really strong PIMCO, right? So I always think I'm saying it wrong. Did I
That's
say
why
it
I'm
right?
not successful 100% of the time in my.
What?
That's why I'm not, my strategy isn't successful 100% of the time.
Right, exactly. Okay, so I just wanted to take a moment and talk about, there was a video going around with the saddest looking people on it saying how they had been left alone their whole lives and everything was terrible because they had nobody looking out for them, and it was just terrible. So I just wanted to point out there is an association that has been in business for 50 years looking out for mortgage brokers, National Association of Mortgage Brokers, NAM. And they were recently at a regulatory conference called ARMOR. It's the American Association of Residential Mortgage Regulators. The reason that this is important to know is that this is where, I mean, 35 states were there. They all, so the states come together and they discuss what's going on in the market. And so who's our voice when they're there? So NAM was there representing mortgage brokers, which is good to know. So their long-term goal, which I think is a good one, is to make the states more uniform in their regulations. I didn't realize that even today, LOs in Colorado don't need to be licensed. I mean, I'm sure they have no interest whatsoever in having to be licensed, but for the rest of us, that just seems kind of odd, doesn't it?
So we could do a loan in Colorado?
Pardon me?
So you and I could just do a loan in Colorado then?
I mean, I'm going to check because maybe, I mean, if you don't have to be licensed, you do.
There are a few states like that where you don't have to do anything. You just need to register and you're done.
Right. So they do have NMLS. They did do their 20 hours. They did do their 8. It's not like they're not, there are no requirements, but those are federal requirements, not state requirements, which is interesting, right? So, so this organization, ARMOR, which is an interesting acronym, but they've set, it's a really long act. I mean, I had to have them repeat it like 4 times. I'm like, slower. I don't know shorthand. Anyway, so they've set up they've set it up so that like large companies who are in multiple states, they can have multi-state exams. And so they are only having one audit that they're going through for multiple states versus having to be audited in each individual state, which I think is a plus. I think that makes so much sense. They invite industry to attend, and then industry gets, and we're industry, by the way, gets to have some input in there. So the people who attend are state regulators. Apparently the American Finance Association was there, but they certainly weren't representing us. Private companies, attorney firms, banks. So anyway, again, NAM was there. They sent Rocky Andrews, who's a former state NAM president. He's out of Arizona, and Valerie Saunders, who has been NAM, basically the queen of NAM for as long as I can remember, and is president-elect next year. So they were there just making sure that we had a voice, which I really appreciate. Their number one issue that they're seeing, by the way, this regulatory agency or these regulators, they're having audit concerns over inaccurate change in circumstances. I was surprised that was the thing. So just watch that, you guys, because they're now hyper focused on it. And so we don't want it to be an issue for us. Some of the other things they're looking at, which would be of interest to us, is they're trying to figure out how to allow for remote workers, because there was some conversation about whether people's home offices were going to need to be licensed or not. Yeah. It doesn't look like that's going to happen. Unless you are promoting your home office as a place that you do business or meeting clients there. So make sure you're not doing any of those things. And
especially if you're an FHA lender. If you're an FHA lender, then you have to have a place of business that's not your home. And you have to be there, 65% of the time or something crazy like that.
And in some states, the LO has to work within 50 miles of a branch. I didn't know that. So they're working on redoing the NMLS website, which I know that it's challenging a lot for a lot of us, but apparently they've been working on that for 5 years. So don't hold your breath. And they're trying to fix the issue that people had last year, which I had not heard of. Kevin, tell me if you did. I guess that people weren't receiving any acknowledgement of the payment they were making when they were renewing their NMLS. And so people were paying 2 or 3 times. And had you heard of that? I had not.
I did hear that people weren't getting things. I didn't hear about people paying 2 or 3 times.
Yeah,
that's
anyway. I mean, it's another reason not to wait till December 30th to try to renew your NMLS, because then you don't have time to figure it out, right?
So if I paid it 3 or 4 times, that mean I'm renewed for 3 or 4 years going out?
Such an LO.
Right. Oh my God, that is the most Kevin Casey thing you'll ever hear. I mean, yeah, of course. Of
Hey, they
course.
took the money. Come on.
Oh my God. I
Upset.
paid 4 house payments at a time. What do you mean I'm late and in foreclosure? Oh my goodness. Yeah. So anyway, there you go.
I will say, on one note, something that you mentioned is that doing that multi-state exam. I have a couple colleagues at other companies that have gone through some of the first iterations of that. And I've heard it's not as streamlined as they want it to be. So hopefully they're working on making that a little more how it should be, because it is a great idea. I know
Great
it
idea.
would make things so helpful. So yeah, I'm really glad to see them working on that more.
They never said it was streamlined, Erin. They just
You're
said,
right. This is government we're talking about.
right. Hello.
Yeah.
Let's keep it in perspective. They may not be doing it well, but at least they're trying to do it, right? So, oh my God, someone made the comment, I don't want an FHR borrower coming to my house. Anyway, all right. So, and then there's a comment here to support the Mortgage Action Alliance, which is MBA's legislative arm, right? They're connected to MBA, aren't they? Yeah, they're great.
Mhm.
They do really,
Yeah.
really good work.
Yes.
And they are, so yes, okay, so this is just my opinion, not speaking for an entire group of people. I know that there's been some division between the organizations, and sometimes MBA and sometimes I think that we should work together as much as we can. There
Yes.
is more, we share more than we have differences. And
Correct.
so let's focus on the things that we can support each other through. And then on occasion, we will not be like-minded, and that's okay. It's so that's my suggestion. So yes, support MBA. Don't isolate yourself and think, oh, I'm this and that's all I am, et cetera, et cetera. So, so yeah, that is a really good point. Mortgage Action Alliance are a really good group. Erin, do you have the information for how to get, because I know you're involved in MBA, right?
TMBA, Texas Mortgage Bankers Association, but I am I don't know if member is the right word to say, but I am, part of the Mortgage Action Alliance. I mean, I would just Google it. You
I
can
am
go
too.
to, I'm sure, MBA's website and find it, and you can just sign up to receive their calls to action, and they make
Yes.
it so flippin' easy. Like, you
Yes.
literally just go, like, put in your address, it drafts the letter for you, you send it off. Matt mentioned the remote online notary bill. You can go do that now and send that request to your Congress, I think it's senators or Congress people, I can't remember which on that one, but it's great. Ma is fantastic.
Yeah, no, I totally agree. So we have a question here from Victor. He says, is it true that some loan companies are going under? I heard it on TV. And yes, they are. There's a lot of consolidation going on. There are some companies who are not going to make it through. We wonder what the hell they were doing in 2020 and 21 when they were making money hand over fist. Any insight into that, Erin? Like, where did it go?
Well, now they're losing money hand over fist, and they're losing it as faster than they made it, because they got caught with the rates went up, and then they closed a bunch of loans at a low interest rate, and suddenly there's no market for them, and now they're stuck with those loans on their portfolio, which means there's a whole lot more loans they can't do anymore, and they're just locked in that cycle.
Or if they were just doing refis, those people are not going to make it. I
Right.
mean, it's too late to train. Well, okay, I shouldn't say that. It's not completely too late. If you're a large company with huge expenses, it might be a little late. What do you think, Erin?
Yeah, I mean, I agree. We actually stopped marketing refis in October of 2020, and we doubled down on our purchase business. And so, that fortunately ended up being a good decision. And so so we haven't had the extreme decrease in business that other people have seen. I don't know. I mean, if we didn't do that, if we focused solely on purchase businesses, it would be or refis, it would be a totally different story for us. And there are a lot of companies out there right now that are suffering for it. I think just go back to that discussion we had about Wells Fargo and how they are cutting off some relationships. And I guarantee you the ones that are losing are ones that focus primarily on doing refi business.
Now, there's some businesses that are growing right now, and they're actually looking to acquire other companies. They're either growing because some of them are small, and they see this market as a great opportunity to grow because they don't have a lot of brokers, so they can just focus on growing more brokers and growing their small businesses. But the larger ones, they're either at capacity and they set to fail, or they are going to acquire somebody and grow again. So how do you see who's being acquired? And like, if you were acquiring a company, what are you looking for? And if you are wanting to be acquired, why would you want to be acquired? It's kind of a,
Yeah, I mean, I'll answer the former first. So if I was looking to be acquired, it's because I want to get out, right? I've
Yep.
done this, I've been here, I built up a bunch of cash, I've got a good solid book of business that's with somebody coming in, right? And I'm done, I'm out, which, one of these days, hopefully I'll be there. But if I am looking to acquire a business, I'm looking to get into a marketplace that I couldn't otherwise get in. But you have to be really careful about that, because really, would it be a better play to just recruit those originators away versus acquire a business where, you're just getting a balance sheet basically, right? So, the acquisitions, people are kind of hot for it, but if you look at it and it may not make a lot of sense, and you really have to look at what you're truly buying. So, if you're going into a market where this one brand has all the sway and all of the market share and all of that, then yeah, maybe it makes sense. But if I was looking to acquire business, I would be looking at, hey, where are really good loan officers that fit with what we'd want to do and what we're trying to do that would fit into our model versus acquiring a company. But
Right.
there are a lot of people out there looking to acquire and just get market share.
Exactly.
You're trying to buy the dip, basically, right?
Yep.
The
No, that's
dip,
no way of growing in a dip. I did it with a charity one time. We were 2008, everything's crashing and burning, and we just acquired another charity that did the exact same we did in the next county, and we increased our business. And the thought process at the time was, hey, we keep all our people employed, this will work, and it did work out.
Yeah.
So it can be a solution sometimes. The company that's acquired, they still end up losing sometimes because the acquiring company just lets their staff go and keeps the business. But
yeah, and there's culture, there's all kinds of things that you really have to look through.
Yeah.
It sounds
Right.
good on paper, but it's hard to do.
Well, and I think there's a lot of movement right now too. My gosh, the recruiters are going nuts and people are moving all over the place. And I think it's interesting because, any company that is spending a ton of money trying to get a loan officer right now, I mean, I don't want them spending money on that, right? I want them spending money on things that are going to help improve the loan officers who are there, their business, right? Or their productivity, or they're lowering their cost of originating a loan, or all the things that would trickle down into having better rates, for instance. So it's interesting out there. And, a lot of the people who are being laid off right now are, they went chasing signing bonuses. And so they kind of got paid up front and now they have no jobs. So, but the flip side of that is I met on the airplane the other night, this woman who's worked for B of A as an underwriter for 27 years. I'm like, wow, that's amazing. So not, but she feels very solid in her job right now. And I guess that makes sense. So anyway, it's, don't go chasing the shiny objects. I guess that's
It'll hit your rate sheet. It's going to hit your rate sheet. That big signing
It'll hit
bonus
your
sounds
rate
great, but it's going to hit your rate sheet.
Exactly.
Yeah.
Exactly. And that matters to all of us. Okay. So there's a few upcoming events that you might want to attend. If you're in Southern California on September 15th from 5 to 8, there is a Top Golf. I don't know what that is, but I've seen it in different parts of the country. You go and hit,
it's like a virtual golf.
yeah. So you go hit, anyway, bottom line is this chapter, OC Sola chapter, they throw great events. It'll be fun. You'll be able to, hang out with other LOs and get some, human time. That would be something.
Yep.
I'm sure there will be a lot of alcohol and
I'll be there.
so they're looking for people who want to attend and also for sponsors who want to be sponsors. So just be aware of that. That is upcoming. Kevin, what else you got?
We got North Bay has a non-QM event coming up on August 31st in San Rafael. So look out for that. That's a good one. We went to that one last when they did that, 3 or 4 months ago.
Yeah, it was good. Yeah.
A few more speakers to it this time. It just little tricks and nuances you can learn and pick up a deal. And that's,
Well, that's the thing.
valuable.
These non-QM lenders, a lot of them have little specific niches. They're not all the same. It might seem like it, but boy, you see the emails that we're all getting where, they're doing all this stuff that you were not aware of. But the other thing too, is that while we've heard that LTVs are decreasing and, I noticed that like by 5% with one in particular. I mean, so they didn't go from 90% to 65%. They went from 90% to 85%, which, okay, it's not great, but it's palatable. You can manage it, right? So what date is North Bay's? non-QM thing?
North Bay's is August 31st, Wednesday.
Oh, that is coming up,
Coming up,
people.
next
Yeah.
week.
And again, you could go like hang out with humans who do what you do every day. I mean, can you imagine? Holy moly. We also have NMLS trainings that are happening.
A bunch of them.
Yeah, a bunch of them, live ones and online. So again, same chapter, ASOLA. 3 upcoming, these are all virtual, so anyone can sign up for them. I'm doing 2 of them. Dave Luna is doing 1. So that's SOLA OC in like September, October. And then North Bay has one. Oh my God, I should know the date. Anyway, but look on the Mortgage Educators website. Mortgage Educators is a great way to get your NMLS training knocked out. Kevin and I both teach for them. And obviously Dave Luna is like the king of NMLS. So there you go. There you go.
Yeah, we have one in Greater Ventura, September 22nd. You got that one?
Thank you. Yes,
Yeah.
very good. Very, very good.
That's 2 of us.
What?
That's the 2 of us teaching that.
Yeah,
one.
Kevin and I like training together or teaching together because first of all, it gives
It's
us
like this, but for 8 hours.
so if you can stand it, you might love it. And if you can't, don't come. Okay, so there's a lot going on right now, as always. So first of all, I thought it was interesting. The Atlanta Fed has revised their GDP estimates like 3 times recently. So they thought the Q3 GDP was going to be 2.5%, right? Then they revised it to 1.8%. Now they're at 1.6%. So those estimates are a moving target. We'll see how that goes. I mean, typically when you would say, oh, Atlanta Fed, I would pay attention and go, oh, what are they saying? And now I'm like, they're trying to pin Jell-O to the wall. So there you go. Retail sales in July were flat. They were expecting an increase. This will be interesting to see how it plays out. Core retail went up 0.2%, and is year over year, it's up 10%. So, retail sales year over year are strong still, but it'll be interesting to see what's happening going forward, because we're hearing a lot about people are having to use their credit cards to pay for their normal living expenses. Actually, this is something, and I don't know if you can speak to it. If you can't, just tell me to shut up. But we had a conversation 2 weeks ago where we were talking about how credit card balances have gone through the roof, right? And someone was saying that was a good sign, like it was a sign that the economy was strong and people were spending. And I was saying, and they told me I was wrong, because I had said that it was a bad sign because people couldn't afford to pay them off every month, and they're putting their living expenses on there. Do you have any take on this?
Yeah, I mean, I guess I would have to say, what's the trend? Is it like credit card balances are going up, for 1 month and then it's getting paid off because I'm buying a ton of super expensive goodies? Probably not, if they're as a whole increasing. So I would say that is not a good sign. Okay. I know things have gotten far less affordable for people. People are struggling. So I would have to say, I don't think it's a great sign.
Yeah, that's what I think. Kevin, what do you think?
I agree. I think as people are looking at, like I did this weekend, I went to Safeway to buy some milk, and it was $7.99 because it's only everything, all the cheap stuff had already been bought, and only the good quality milk, was the only one left on the counter. I'm like, I guess I got to pay $7.99 today because I want milk.
I thought you got milk from the cow in the backyard. No?
Yeah, no cow.
Weird. Okay, NBA mortgage apps refis are down 5% week over week. What a shocker. 82% year over year. So again, if you missed the memo and have not pivoted to focusing on refinances, maybe now's the time, right? But I would like to point out once again, because we're always startled at this number, 31% of all transactions are still refis. Is that crazy? That has been very consistent, by the way. There's
equity taking. I know values have, at least in my opinion, what I'm seeing here in Austin, it seems like values have peaked. So maybe equity taking.
We won't tell you what we're hearing about the Austin market, but we would agree maybe your prices have peaked.
Yeah, that's fine. I'm ready for them to
I know. Well, I think we're all ready for, like, nobody wants 30 offers or 50 offers or, and 30% appreciation. So that actually leads us to the next thing, which is there is a difference between housing activity and price, right? So there, all these people are like, oh my God, is it Lawrence Yun, the NAR guy, economist, he's talking about, housing recession. Well, there's a difference between activity, which definitely is down, and price, which is definitely at least stable. And so Zillow came out with their home price index for July. It was down 0.1%, right? Okay, first of all, it's Zillow, so do the math on that. But also 0.1%. Okay, 0.1%. But also they were looking at median price, not at home price, right? Or average home price. And so it doesn't mean that prices are declining, but we are seeing some stabilization, which we've all been praying for, right? So Zillow's forecast, they're expecting 2.4% appreciation in the next 12 months, not depreciation, even though we had that whopping 0.1, and again, median home price. Guys, it is going to be a, how shall I put it? There's a lot going on the rest of the week, so stay tuned. Don't float your loans. Don't float your loans. We have Jackson Hole Symposium tomorrow.
Especially before Friday. Friday's going to be a big day.
Yeah,
Friday's gonna
because
be big.
Jerome Powell is speaking on Friday. And do you remember in June,
Thursday?
do you remember in June when Jerome Powell told the whole world that maybe they should pause on buying homes? I was saying that he and I need to go to therapy together because I'm not over it. I'm like, what in the hell is the Fed chair doing, telling people when to buy a house? Like, that is not your job. So anyway, if I have the chance, I may share that information with him. I don't know if they'll let me close enough, but we'll see. So signed contracts on new homes, they have definitely moderated. So there are less people signing contracts on new homes, but the prices are stable. So, is that bad or good? It's an activity recession, not a value recession. That's what Barry Habib's crew said. And then we have
that's what Lawrence Yu's numbers were saying too. He didn't say that, but that's exactly what he's saying. It's volume is down, not prices.
Right. So maybe
it's really important what you're saying about the median price. Median price going down, that just means that more people bought cheaper homes than more expensive homes. It doesn't mean the home values went down.
It doesn't mean home values went
down.
down.
The median value went down, then the home values went down.
See, Erin, I told you he's not just eye candy all the time.
I know, he's surprising me over and over.
I know.
Again.
Every once in a while he opens.
Get a little verklempt over here. I don't know.
Exactly. Just take a moment for yourself while I remind everyone that tomorrow we have pending home sales, and that is 90% of the market. New home sales, 10% of the market. So that new home sales number matters, but it is not going to drive the market but tomorrow's surely will. Surely. So anyway, because people don't always understand these numbers, right? So anyway, jobless claims, it's interesting to watch all these. It is noon. Was that a fast hour, Erin? I told you.
I loved it. This is great.
I told you it was gonna go.
My time blocking worked today.
You what?
My time blocking worked great today.
Perfect. All right. Well, it was lovely seeing you. And next week we have Mark McArdle with the CFPB joining us. If you have questions for them, will you please email me at audrey@mortgagepros411.com. I'd like to start putting together a list of things that I want to talk to him about, or that we want to talk to him about. And so if you have ideas, things that you would like to understand, you have questions, send them to me. It'd be nice if I had them ahead of time so I could sort of sift through them, figure out, anyway, so there you go.
A little quick housekeeping. Make sure you register for our webinars before 11 o'clock, because once we start the webinar, you can no longer register.
I'm trying to fix that but Zoom sucks. Excuse me. I did say that. I have spent hours. I have PTSD symptoms from them, their hold music, because I'll hold, and then boom, they just disconnect me. But finally, I got a hold of some lady yesterday, and she basically told me if I spent $8 billion, I could get phone support. So I am trying to fix the glitches we have with our registration, but I'm having trouble. So if any of you feel that you're Zoom experts or you know someone, let me know. Audrey@mortgagepros411.com. With that, we'll see you next week with our friends at the CFPB. Thank you, Erin. You are a dream. I'm so happy to know you now. Have a great week. Bye, guys.
Appreciate it.